Hello, listeners, and welcome to another episode of Cognitive Dissidence. As usual, I'm your host. I'm Jacob Shapiro. I'm a partner and the director of geopolitical analysis at Cognitive Investments. I'm coming to you from Wisconsin Dells, Wisconsin. I am giving a speech here at the PDPW, Professional Dairy Producers of Wisconsin event here shortly. It is one of my favorite events because they have an unlimited all-you-can-eat grilled cheese station as well as lots of chocolate milk and ice cream sandwiches. So I'm having a good time. Rob and I are back at it for our weekly chat. If you want to talk about anything you heard in this episode, you can email me at jacob@cognitive.investments. And auspiciously, this podcast is being published on March the 15th, which allows me to say and bid you that a soothsayer bids you beware the Ides of March, wherever and whenever you are. Take good care of each other. Take care of the people you love. Cheers and see you out.
The future's bright. You've got God on your side.
All right, Rob, greetings from the water park capital of the world, Wisconsin Dells, Wisconsin. I bet for once you're jealous of me rather than me being jealous of you in Paris, aren't you?
Oh, totally. Especially in March.
Well, it's actually it's an unseasonable 60 degrees here. I feel like an idiot for bringing my winter coat and dragging it through various flights and through airports and things like that. As usual, the last couple of weeks, we'll do a little microgeopolitics before we get into. I'm always excited for our conversations, but this is a particularly interesting week, so I'm looking forward to this. But let's talk a little bit about Wisconsin Dells, Wisconsin, which goes back to this. I feel like the thread in these various towns that I've been to in Wisconsin as I speak at various events and really throughout the Midwest is that things don't really change that much. You know, we talked about how manufacturing towns were always manufacturing towns or tech hubs were always tech hubs. And Wisconsin Dells has always been a tourist attraction, basically since the very start. So it takes its name from the Dells of the Wisconsin River, which is a glacial formed gorge that features beautiful sandstone formations along the banks of the Wisconsin River. It was named by the early French because this was old French territory for rapids or narrows on the river. It's the Native Americans who were here before the French were the Ho-Chunk and the Menominee, and the Ho-Chunk name for this part of the country means rocks close together. So that gives you a little sense of what things look like here. The town was founded in 1856 by the Wisconsin Hydraulic Company, which was a dam building and real estate investment business. And the town was not originally called Wisconsin Dells. It was originally called Kilbourne City for a guy named Byron Kilbourne. And most of my microgeopolitical take here is going to dive into this fascinating huckster. Because my God, what a story this guy has. So born in Connecticut, I believe. He's a surveyor, railroad executive, politician. He's even sort of involved in the founding of Milwaukee, serves as the mayor of Milwaukee 2 different times, comes from a pretty good U.S. pedigree. His father was a colonel in the War of 1812 and served as a U.S. Member of the U.S. House of Representatives from the state of Ohio at the time. He's basically, throughout his entire life, gets accused of corruption over and over and over again, and somehow never goes to jail. He just moves on to wherever he goes next and does more corruption. He starts in Milwaukee, and I didn't really know this about Milwaukee. Have you heard of the Milwaukee Bridge Wars, Rob?
No, I haven't.
So the area that is Milwaukee today was originally 3 different settlements. Juneautown, which was on the east side of the Milwaukee River, Byron Kilbourne's Kilbourne Town on the west side of the river, and then Walker's Point to the south, which was founded by some other guy. And basically all of these guys wanted to build the railroads and build. Kilbourne's first sort of thing there was he had a steam ship collection that was going up and down the river and things like that. And all of them wanted to be the main site of Milwaukee. And Kilbourne just starts building bridges across the river, doing whatever he wants. And at one point, people break out like old guns and artillery and things like that, and they're going to fight each other over who gets to build the bridge that connects Milwaukee to the Mississippi River and everything else. And they even get to Kilbourne's house, whose house apparently overlooks his biggest building project here. And only because his infant daughter tragically died the night before, they decide, we're not going to blow this guy's house up and go to war. We're going to figure out some way to make things okay. And they all go away. At least that's what the story tells. So there's that. He's obsessed with this idea of basically making a link between Milwaukee and this part of Wisconsin in general and the Mississippi River. He even writes once that if he's the first one to build a rail link between Milwaukee and the river, then, quote, Chicago will not dare to touch our territory. We can defy the world to come between us and this great Northwest. I mean, just real delusions of grandeur. Um, the other thing about this was first it's steamboats and then it's bridges, but he really gets focused on the railroad. And the thing about railroad is that it's capital intensive. You need a lot of capital up front, and there's no capital in the wilderness of Wisconsin. And there's nothing you can even really convert to capital except the land itself, especially at the different prospective town sites along where they want to put up all the railroads. So after he does his little Milwaukee Bridge War thing, he starts with something called the Milwaukee and Mississippi Railroad, and he tries to find cash. He even tries to go to the Milwaukee school system and borrow from the Milwaukee school system to build some of his railroads. He ends up being found out that he bribes lots of construction companies and politicians with contracts and paybacks for this, and he gets fired from that railroad. Now, you would think he gets thrown in jail or he goes somewhere else. No, he just goes to the La Crosse and Milwaukee land grant scandal, where he moves on to the La Crosse and Milwaukee Railroad, which is chartered by Kilbourne and a couple other guys in 1852. Have you heard of the La Crosse Railroad scandal or the Black Book scandal, Rob? Really fascinating. We could do a whole episode just on this. The way that he finances the construction of this railroad um, is described by one sort of Wisconsin historian as a plan unique in the annals of railroad finance. And the historian did not mean that in a nice way. And basically, he convinces farmers along the route to mortgage their farms as security for railroad bonds that can then be sold in Eastern money markets. And then the farmer gets railroad stocks whose dividends, quote unquote, are signed back to the company. And so by this sort of irregular transaction, the farmer is supposed to come into fully paid shares of railroad stock without having to put up any cash. It was just you sign over the land as a security and you go from there. And things go okay for a while because 1853 to 1856 is boomtown in this part of the world. They're building railroads everywhere, and everybody is convinced, oh, nothing's going to go bad, everything is fine. But sort of needless to say, eventually the boom blows up and the stock proves worthless, and a lot of farmers are actually compelled to pay their mortgages or even lose their farms. And so all of this might not have happened actually until there's one part of land that Kilbourne wants to acquire, and he gets his lawyer on trying to acquire it and absorbing it in this part of the country, the Milwaukee and Watertown Railroad. And at that point, whether it's people figure him out or people are annoyed that he's getting too big, there's an investigation into him, and they find out all of these different paybacks and bribes and things like that that he pushed through, in addition to this scheme to try and raise capital out of thin air where there really was no capital. And at this point, he sort of gets embarrassed. This is the Black Book scandal or whatever, and his interests here go away, and he gets kicked out. And it's actually a really, really important moment in Wisconsin history because it's so corrupt that basically it provides the impetus for the La Follette progressive movement, and all of the rules about corruption and regulating sort of economic activity in Wisconsin have Kilbourne in mind because he was literally so bad, and his corruption shocked people so much and made farmers lose their farms that people just couldn't believe it. Now, this, by the way, has nothing to do with Wisconsin Dells. Wisconsin Dells doesn't come onto the map, as I said. Wisconsin Hydraulic Company, 1852. He's trying to build a dam here to separate the upper and lower Dells. The lumbermen who were in this part of the country were really mad at him because his dam was going to block the way that they shipped their lumber down the river. And in 1859, the lumbermen just destroy his dam that he's trying to construct on the Dells, and he can't do anything because he's this corrupt guy who has this awful reputation. And eventually he retires to ignominy in Jacksonville, Florida, and there he passes away trying to concoct some new terrible scheme. And
Sounds like a classic American story.
Well, sort of. And the weird thing is, it started as Kilbourne City. It goes to Kilbourne in 1895, and then it's changed to Wisconsin Dells in 1931. The dam is called the Kilbourne Dam, and it eventually gets built in 1909 because I guess the lumbermen just I don't know what happened. They couldn't build it off. But since the very beginning of Wisconsin Dells, it was a tourist place. It was where people came to look at the landscape, and I mean, it's become this water park kitschy mecca or whatever. The only famous person I can find who has any connection to Wisconsin Dells is Maria Isabella Boyd. I am betting that a carpetbagger like you does not know who that is, Rob. Is that correct? Yes. Well, she is the Cleopatra of secession, the siren of the Shenandoah, the Confederate Mata Hari. She was a Confederate spy in the American Civil War. She operated from her father's hotel in Front Royal, Virginia, and at one point provided very valuable information to Confederate General Stonewall Jackson in 1862. He actually wrote her a thank you note, which has been preserved for prosperity, and she was awarded the Southern Cross of Honor for her contributions to the Confederacy, however it was. Alan Pinkerton and his men actually assigned 3 men to work on her case, and they finally captured her in July 1862 after her lover gave her up, and they put her in prison for a while, but she always seemed to squirm out of it. They let her go because I guess she was a woman or they felt bad for her. She got arrested again, but she's released because she contracted typhoid and people felt bad for her, I guess. She eventually assumes the stage name Nina Benjamin and goes to various cities and ends up in New Orleans, where she marries a guy named John Swainston Hammond in 1869, has a couple of kids, and then divorces him and goes on a wild tour of the United States, giving lectures about her time as a Civil War spy. And she passes away on one of these tours as she's giving a discussion in Wisconsin Dells, Wisconsin, which at the time is Kilbourne, Wisconsin. So that's my microgeopolitics for the week. Is that not the most fascinating thing you've ever heard? And by the way, that gives you a sense of where I am right now.
Well, damn. Next time someone's flying over the middle of the country, they can think about this and realize how much color they're missing.
Yeah, I mean, I found this one history of this region which was so incredible, and one of the quotes that I underlined from it was the ingenuity displayed in the attempt to veil the transactions that Kilbourne was engaged in are beyond the possibility of deception is so supremely unique as to extort attention. So, like Kilbourne is I mean, the story of the American huckster is long. It's been there a long time, but he was particularly, I guess, notable and. Wisconsin Dells, in some way, is his legacy for better and for worse. Anything else you want to say about? I mean, there's nothing really to talk. There's no globalization or manufacturing or tech revolution story in there. There's just good old hucksterism. Is there anything you want to pitch, knock on from that level, or you want to dive into the next thing?
Well, I wouldn't understate how important water parks are to the economy. Like, let's not ignore that sector.
Mm-hmm. Yeah. Okay, Mr. Paris. Oh, we don't have water parks. We're fancy and we do sophisticated things. Always punching down, Rob. Always punching down on the unsophisticated Wisconsin water park person.
Actually, do you know what a really cool book about Wisconsin is that I guarantee almost none of the listeners have ever heard of, which is worth seeking out and looking at, and you would enjoy it as well. It's called Wisconsin Death Trip. Have you heard of this?
I have not.
It's a very creepy photography book, and it was I forget the exact story, but a photographer who went through Wisconsin around the late 1800s, and I think they collected, if I remember this right, at the time they would take photos of newly deceased people, and this book is a collection of the photos, but it's extremely poignant and haunting, and it's a good taste of Wisconsin on the dark side of the more macabre side of the ledger, for sure. Wisconsin Death Trip.
Yeah, no offense. I'm going to stick to my water parks. I'll leave Wisconsin Death Trip for you.
It's much cooler than I'm making it out to be.
Yeah, I hope so. I'll check it out, but that doesn't sound like where I want to spend my time. Okay, Rob, let's transition to another cool and historically tinged conversation that is very different. And why don't we start with sort of the present and work our way back? And so the question that I want to pose to you to start is, what is a doji?
A doji is a cross. I think that's the easiest way to think about it. If you think of the traditional Christian cross with sort of a longer vertical axis and a shorter horizontal axis somewhere in the middle, but toward the top. That is a doji, and it's a candlestick charting pattern that happens. If you're not familiar, most of the listeners will be familiar, but for those who aren't, candlesticks are a way to measure during any period of time where did the price of any market index or stock or currency or whatever, where did it start, where did it go to during the time period, how high and how low, and then where did it close. And a doji, if you picture the cross, is a candlestick that starts at 100 and swings high up and then high down and then closes exactly at 100. And the reason why we bring this up is because the S&P 500 made a very rare weekly doji last week. And that is a whole conversation about what that means, but that's the context here.
How rare is that? Like, how often when you're looking at various charts do you see dojis?
It depends on the chart. It's for the S&P. It's fairly rare, and what it means, or the way that it's interpreted, is that it's a battle. So traditionally, a doji is taken as a sign of potential reversal, that a trend that has been in place is ready to reverse because the doji represents a shock. So if you were to look at a chart of the S&P over the last 5 months, it's basically very low vol, just like a line up and to the right. So the bulls are in control, buying, 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 buying. Yeah, feeling good, feeling good. Market's going up, up, up. And then the doji represents a slap in the face. It's all of a sudden the bulls tried to take that market higher, and they got a sharp reversal. So think of it in military terms. You're charging through. You made it through their lines. Your troops are blitzkrieging through the other side's army, and they're all retreating back to Paris. And then they hold you on the line of the Marne, and whoosh, your army faces a major setback. And there's a psychological impact to this because all of a sudden you suffered a reversal. And I want to talk a little bit about sort of Japan and where this comes from and why this is relevant more broadly. But it's an interesting setup here after what we've experienced for the last 5 months. Opening up a conversation about markets, but this is an important thing to be mindful of, that something might be changing in that trend.
Well, before we get into the history of it, because I know the both of us, and if we get started on the history, we're never going to leave it. Why don't we do last week and give away the punchline? So let's talk about, what do you see in the S&P 500 as a result of the doji? Has that move been confirmed this week? Is it still sort of up for grabs? Like, what is the key takeaway? And then we'll get into what's behind it.
Well, whether it's confirmed or not, we don't know yet because the market, as we record, still has 2 full days of trading. So we have to wait and evaluate. And if the market closes higher this week, then it could be invalidated and it could be healing itself. So it's early to say what the implications are yet. But what are the underpinnings coming into this? Why am I highlighting this? Because market breadth is something that is really important that we try to look at as part of our process. And what's been going on in the market, as many people know, is that breadth is narrowing more and more and more. So if you were to take the average stock in the US, it's done not very well this year. Small cap stocks, the Russell 2000, for example, has not done well. Everyone talks about the Magnificent Seven or whatever the latest moniker is. I don't even keep track anymore. It changes like every 2 months now. The Fangs, the Fanags, whatever. Um, but the reality is that the leadership of the market has been sort of narrowing in a smaller and smaller group of very high profile stocks where there's a lot of speculative froth and speculative activity and retail um, uh, 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 sort of wagering going on using options, among other things. So that is the background within the equity market itself, which is why we sort of put it on the yellow flag. The other thing that is relevant is, we use intermarket analysis as part of what we do in evaluating markets. And what does that mean? It means you don't want to just look at equity markets. You want to look at bonds and currencies and commodities. And when certain things move together and then one of them zigs and the other zags, that's important. So what we've been seeing more recently is from Thanksgiving, basically last year, or Halloween maybe, both equity markets and bond markets were running together. That was when the expectations really started to grow that the Fed was going to cut. Bond yields went down, bond prices went up, and between then and the end of Christmas, just everyone was making hay on everything. Everything was going up. But since Christmas week, the majority of stuff has stagnated and suffered, and bonds themselves are down this year.
Mm-hmm.
So, sort of one of the key planks of this market narrative of the S&P going up like it has is now going in the other direction. So, it's just about taking a weight of the evidence approach and using different perspectives and different tools to gauge the risks, positive and negative, in the market at any time. And the Doji capped it off for me last week. I said, "Oh my God, there's a Doji now. Now things are really getting saucy." But yeah, that's the background coming into this. So the punchline is risks are really elevated in the market right now, and we've been holding back the reins on U.S. Equity exposure for our clients, and quite possibly we might go full on fetal position with regard to the S&P 500 soon.
Even if the doji gets invalidated at the end of this week, like, if it gets invalidated, is it just sort of a pitched battle that got lost, but the war is still moving in one direction? Or would that invalidation sort of tell you, like, maybe I'm off here, or maybe something else is happening?
Well, I don't know. I mean, it depends on what else is happening at the same time. That's why I say it's a weight of the evidence approach. You never want to take one indicator and base everything on that, because it'll work for you once or twice, and then it'll
Yeah.
throw you for a loop, and you're done.
Okay, so as we get into the fun part of the conversation, at least for us, I thought the best place maybe to start, rather than going straight to 16th and 17th century Japan, would be to start with, what is technical analysis? Because I think that probably links to what we're talking about here, and that really technical analysis has some of its basis in Japanese candlestick charting techniques. So do you think it's a good idea to work our way backwards from there and talk about that for a second?
Yeah, because I mean, the history itself, it's of marginal importance. I mean, I think the key takeaway is, that this is technical analysis, and technical analysis is really just using shapes and colors and figures to gauge people's feelings. I mean, it's about psychology in the end, and measuring psychology, and that's a really important discipline that I think gets vastly overlooked, especially nowadays, um, because other disciplines have become much more popular. But this is, we always say the three legs of the stool for everything we do are fundamentals, which is what's happening in the economy and with businesses; sentiment, what's happening, what do other people think about things; and then technical analysis. What is the market action? What is the market telling you about how people are behaving in groups? And the reason why this is so important is because certain things change, market environments change. Um, it used to be that when bond yields went up, stocks would go down in the 70s. And then for decades, it was the opposite. And now it's the same, it's back to the 70s again. So nothing is ever constant. Technology shifts, the economy changes, but this stuff doesn't change. And that's why the Japan background going to the 1755 is interesting, because when you talk about technical analysis, that's a discipline about humans. And that's something I think anyone can appreciate. And anyone who's at all involved in markets can look around and understands that there's emotion that's deeply involved in investing or trading or whatever you want to describe it as. Whether it's someone bragging, hey, I just made all this money in Nvidia or the meme stock of the day or whatever it may be, or people freaking out and selling everything they have because they're terrified. Um, as long as humans are involved in markets and driving markets, these tools are going to be valid and really important. And it's also why markets will never be efficient, because humans are not efficient. People don't buy and sell things because they're these rational calculating machines of the underlying, discounted cash flow value. No, of course not. So anyway, that's the kind of broad takeaway. But there's one quote that I always love, just getting to how these things are eternal and how important they are, especially having been in the business for doing this for like 20 years now. You appreciate things more deeply, or at a visceral level, that you don't when you're first starting, even if you nod your head and say, oh yeah, sure. And the quote that I always love is from 1989 in an interview in the original Market Wizards book, which is, I don't know if you've ever heard of that. It's 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 a classic. You should read it. It's the interviews with the great traders of the time. But in that book, Ed Seykota, who's one of the traders, he had a quote that he said, win or lose, everyone gets what they really want from the market. And I think I've said this a few times on the podcast before, but it's so profound, and I just come back to it so much that it's worth repeating, because it sounds so like, whatever, that's glib, who cares? That doesn't mean anything to me. But the more that I sort of meditate on that and experience people in this business, and the more wise that truly is. Because if you look around, and any of our listeners know people who invest or know professional money managers, and a lot of them are professional money managers, everyone gets what they really at bottom want from the market. And that's a reflection of their personality, of their desires. Some people are gamblers. They want to gamble. That's what they get a thrill out of. They're not there to make money. They're there to gamble.
Mm-hmm.
Some people are intellectually vain. This is my biggest shortfall that I'm always concerned about, by the way, is like trying to be too clever, right? Like I know a hedge fund manager who was so smart, and he had such an ego because of that, and he was never successful in the end, and ended up kind of crashing and burning because he didn't really want to be successful in terms of doing well for his clients. He wanted everyone to look at him and say, oh my God, that guy's so smart. And that's different. That's getting what you really want out of markets, like in a very subtle, subconscious way. So anyway, that's going on and on, but I think it's worth putting this in the context of, why do these things matter? Why should you care about what the market does? Why, is technical analysis not just mumbo jumbo? A doji is telling us not about some random picture on a screen. It's telling us about the deflated hopes of people who were buying at the start and have been riding this up, and all of a sudden are facing a psychological setback. And how does that resolve itself?
Yeah, I think there's a subset of listeners who will know what technical analysis is, and probably even a subset who are like passionate nerds about technical analysis as well. I think there's also going to be a large percentage of listeners who have no idea what technical analysis is, and there will probably also be a large percentage that think it is mumbo jumbo, that think it's just reading voodoo signals on sheets of paper. And when we first started working together, one of the reasons I felt such a kindred spirit with you was because technical analysis reminds me a lot of geopolitics, and that there are lots of charlatans out there who will say, oh, look, there's a river here and there's a mountain here. Ergo, China is collapsing. There's a famine. Everything's going to be terrible. Who could I possibly be talking about, listeners? But there are plenty of other market analysts out there who will do the, oh my God, death cross crossing over moving average, blah, blah, blah. This means that this is terrible. And silver is breaking out for the first time in 16 years. Like, if you go on Twitter, you can see kind of all of this stuff. And I get the sense that that portion that uses these tools this way, they're the ones that get all the attention. And so things like technical analysis and geopolitical analysis get a bad name. But I've always said geopolitical analysis, in the same way that you said weight of the evidence, you have to think about fundamentals and sentiment and psychology. If you only use geopolitics to understand something, you're going to get it wrong. I guarantee you, if it's the only tool in your toolbox, you're going to get it wrong. And I feel the same way about technical. I feel like there's a kinship there between those things. They're useful tools, but they're tools that get basically lambasted as as something that a huckster like Byron Kilbourne would use, because there are a lot of hucksters that are out there selling their snake oil via how they use these tools in a bad way. I did not read that book that you recommended. I stumbled on a book by Steve Neeson. Have you heard of him? Called Japanese
Yeah.
Candlestick Charting Techniques. And he had a whole discussion at the beginning about technical analysis before he went into his interesting history about sort of where it comes from in Japan. And I wouldn't shortchange that, by the way. I think the history is really important and imbues sort of the tools with what was going on at the particular time. But he sort of at the very beginning has a John Maynard Keynes quote that says, there is nothing so disastrous as a rational investment policy in an irrational world. And he lays out why, even if you think technical analysis is bullshit, it really is the only mechanism that is trying, at least, to give you a measure of the irrationality in markets. So even if you don't believe in it, it's a signal that at least you should sort of have in your toolkit for understanding, well, why is the market reacting this way, and what is going on? I did a little study on where this comes from in Japan. Do you want to start up, or do you want me to tee it up for you to go into the Japanese background here?
No, why don't you tell me what you learned?
All right. So what I learned was, so from 1500 to 1600, well, I sort of knew this before. Japan was constantly at war with itself, and there was always a daimyo who was looking to wrest control of different territories from neighbors and things like that. This roughly 100-year period is referred to as the age of the country at war. So it's not the Japan of today where everybody's polite and orderly. It was a pretty violent and inconsistent place. And three of the biggest generals in the early 1600s at the time who emerge out of this chaos are Nobunaga Ada, Hideyoshi Toyotomi, and Ieyasu Tokugawa. Sorry, I know that I'm not a fluent Japanese speaker. I think I got those pretty right, though. Side note, I knew all of these names and had thought about these guys quite a bit over the last couple of years, because when Annie was born and we were in that first 3 to 6 months of not sleeping, where you are right now, Rob, Netflix had this great documentary about Nobunaga in particular, and also the rise of Hideyoshi and Tokugawa. So like I was like, oh, these guys are back. Like, they're here in my life. I know something about this. And basically their competition, their moves over a 40-year period help unify Japan, and Japan stays unified basically up until the present day. Neeson has this quote in his book that Nobunaga piled the rice, Hideyoshi kneaded the dough, and Tokugawa ate the cake. And the name Tokugawa might mean something to you listeners, because he's the one who eventually emerges as the shogun, and his family rules from 1615 until 1867, and we get into Meiji Restoration land and things like that. Now, what does this have to do with candlestick theory and things like that? Well, apparently it all goes back to the importance of rice in the economy. And it's Hideyoshi who regards Osaka as what he hopes will be Japan's capital, and also its economic center. Osaka has easy access to the sea. It was a national depot for assembling and distributing supplies, and it evolves into a city of commerce and finance. And its wealth is sort of most visible in these vast storehouses of supply, in particular, vast storehouses of rice. And in the 1600s and the 1700s, as things become more unified in Japan itself, Osaka's sort of centrality as a rice exchange in Japan becomes extremely important. And the Dojima Rice Exchange gets set up in the late 1600s in Osaka as merchants are trading rice back and forth. And it became the foundation, really, of Osaka's prosperity. At its heights, you get over 1,300 rice dealers. And this may sound silly, but even though the country was becoming much more unified than it had in the past, there was still no currency standard. So there was no yen at this point, and the different rival areas weren't trading in their own currency. The one thing that they sort of agreed on was rice. And rice becomes the de facto medium of exchange. So a daimyo who needs money sends surplus rice to Osaka, where it's placed in a warehouse with his name, and he's given a coupon as a receipt for the rice, and then he can sell the coupon whenever he wants if he wants to raise money. And so, given that these daimyos were fighting each other and raising armies and things like that, they often had financial problems. So they're selling rice coupons against the next rice delivery or taxing or things like that. And sometimes the rice crop of several years in the future got mortgaged as they were trying to build their armies and things like that. And to give you an idea of the popularity of rice futures trading, in roughly 1750, there were a total of 110,000 bales of rice. 110,000 bales of empty rice coupons traded in Osaka. Yet throughout all of Japan, there were only 30,000 bales of rice. So it's like interesting how the trading sort of gets up. And I don't know, there are different traders that sort of emerge at the center of this, but there's one in particular that Neeson points out. I'm probably going to butcher the name. His name is uh, Munihisa Homa. Homa is a name that I recognize from World War II reading and things like that. But he basically becomes this big trader from Sakata, and his Sakata's rules and his theories about how to manipulate markets and trade these empty rice coupons becomes Japanese candlestick literature. How did I do? Does that sound right?
No, it's perfect. That's exactly right. Murahisa Honma, he's the guy, and he actually has in 1755 he wrote his main book of trading wisdom, and he has a wonderful quote at the start of it that I'd like to read, and he says, "Farming and investment share the same roots. It is the people who do the work, but it is the grace of heaven that makes things grow. Those with a pure mind who believe in heaven will be guided into a bountiful world. The mind always counts more than the loss or profit." And I think it's kind of a charming way to think of it, but it also, this notion of the mind and sort of keeping an even keel, keeping an even mind, and being mindful of how others are behaving is ultimately the core of technical analysis. And it also sort of reveals the wealth of Japan at that time, and how do you say, when you have to go into a market and exchange with other people, you can't have illusions about reality to some extent. Technical analysis is about getting out of your own head and trying to understand where other people are coming from, who's on the other side of the trade. And that's what Munehisa Honma writes a lot about, is understanding, that you're not so different from other people, that when you're bullish, they're going to be bullish, and you have to be mindful of how you stand in relation to others, and be humble and respect, that the market is bigger than you, and all of this sort of traditional trader wisdom. But it's kind of poignant that it emerges during this period of prosperity, and it's poignant that this wisdom emerges 300 years ago, and nothing has changed. If you read any trader book, from Market Wizards to Munehisa Honma, it's the same shit. It's the same wisdom, the same human drives that are behind all of this for hundreds and hundreds of years. So there's something very, very powerful about that, I think.
There is, and this is also why I think the context of where it comes from is actually more important than you were willing to say earlier, because Japan itself is really interesting when you think about it. First of all, you were using martial technology when you were describing technical analysis to begin with, and that's because it comes from an era of extreme violence and war inside of Japan. So all the traders at the time have in their minds, oh my God, the daimyo and the wars, and which faction is going to raise a militia that's going to come and do all these things. Like, it was it becomes a unified society, but it's forged in a crucible of intense violence and intense stability. And that's maybe that made them sensitive to markets, which are also sort of the same. They're volatile and they're sensitive and they do all these other sorts of things. There's also a real strategic tradition in Japan of, and this has worked against Japan in wars and it's worked for them, but for sort of the what Americans would call the silver bullet, like finding the one battle, the one strategy that is going to bring you to ultimate victory. And this worked for Japan in the wars against Russia in 1904 and 1905. It blew up in their faces in World War II because they thought, oh, if we could just do Pearl Harbor, if we could just do this one thing, like the entire tide is going to change. And sometimes it doesn't matter. Like a battle doesn't actually decide the war. And I feel like that's maybe part of it, and maybe one place that technical analysis can take or at least absorb some of that silver bullet mentality. I'd also say, though, on their plus side, and you see this in Japan's foreign policy, you see it, I think, in Japanese culture and behavior. Japan is very comfortable with ambiguity. They have no problem, for instance, in being a geopolitical rival of China and also China being their most important economic trade partner. They don't have this sort of you're with us or against us, everything is black and white. They can very easily shift from, yes, of course we're rivals, and yes, we have to trade with you. We can put on this hat and then we put on this hat, and everything is about strategic ambiguity and being comfortable with that level of ambiguity, which you sort of have to be with what we're talking about. Is it a doji? Is it not a doji? Did it get invalidated? Is it a doji and something else is happening and somewhere else that tells you something different about it? Like there's this ambiguity that is imbued in these tools that I think is maybe one of the reasons that Western users of these tools maybe go off the rails, because it's not a measuring stick. It's not doji equals short S&P 500. It's, oh, okay, this is like one thing on the set of data that I have in front of me. Let me see what is going on with everything else. Let me check in with the other rice traders in Osaka or with this, that, or the other thing. And then maybe I'll make my decision, or maybe I'll stand pat. So I think those are maybe imbued within this form of analysis, and maybe they've been lost to the sands of history. Ooh, that was saccharine.
Yeah, well, there's a certain humility implied in ambiguity and being able to accept ambiguity, right? I really like military metaphors for technical analysis because I think they're so apt. Because really, what it measures is the behavior of people in groups, and a military is exactly that.
Mm.
I mean, so much of military is just morale. I mean, just thinking traditionally, obviously, war has changed quite a bit. But if you think the traditional view of military, the charge, the defense, when you start to break, think of, the Greek hoplites, side by side, and are they going to hold? Are they going to break? Who starts to run first? That's how markets work. And the other analogy that I think is connected to that is sports. I mean, anyone who watches sports, and you and I both are really into that, like the psychology and the sentiment of the players is such an important factor, and it's about people behaving in a group. It's sort of sports are sort of a low-level military conflict. So I really like those metaphors because I think people behave in groups similarly from a psychological standpoint, whether you're talking about in a game or in a war or in markets, and it lends itself to similar imagery.
Well, yeah, and the thing that war and sports and markets have in common is ultimately, all my comments about ambiguity aside, there's a winner and a loser. Somebody wins and somebody loses. And then whoever wins also gets to write history. This was another thing that I thought was interesting about Homa. Neeson in his book talks about sort of the legend that rose up around him and how he made 100 consecutive winning trades and never had a bad one as he amassed this huge fortune. And I wonder, like, that must have been difficult for him, because at that point he goes from being a trader to being, the psychology is he'll never lose. So he could make a bad trade and people would be, oh, Homa's doing it, so it must be the right trade, and people would pile in. And I wonder if Warren Buffett has that feeling too. Like he just got some big calls right early on, or a reputation or a psychology emerged around him. And now when Warren Buffett says, oh, I'm buying Japanese stocks or I'm buying this, like there's a there's like a psychological sympathy rally because of course the wizard from Omaha like knows what he's doing. So it's that's also gets in there with the psychology. I don't know if you, I mean, obviously we're not there yet because nobody knows who we are aside from you faithful listeners, but must be a good
Although,
problem to have when you get to
yeah,
that point.
that'd be nice when we say, "Oh, you think Japan's going to go up? Oh, it's going to go up." Um, I think there's a big difference in that phenomenon between market investors and people in business.
Mm,
So I think the big difference is people in business, generally speaking, you get a big hit. Like you see this with CEOs a lot. So oftentimes a CEO will have great success doing something. They've turned around a company, they've grown it into something big, and then they sort of coast and the deal flow comes to them. They sort of become like a black hole in the
mm-hmm.
business universe where they just suck in opportunities and fame and fawning, and and because of that, they tend to do very well because it's about deal flow. It's about you know drawing people's attention to you, drawing their attentions to you. Whereas in trading, no one is bigger than the market, and I think that's why I find people like Munehisa Honma so interesting. Like I guarantee the guy didn't have 100, winning trades in a row. It's just that's the legend grows in the telling sort of thing. But just the notion of no matter how big you are, I think Paul Tudor Jones, your boy, is expresses many of the same things. Like even at his peak, when he was the big, excuse my language, the big swinging dick of the financial world, what he would say before anything else was, "I'm terrified. I'm always terrified that everything I'm doing is wrong." Right, and that's the mentality that you need, and it's very rare. So. Uh, I guess one takeaway for listeners or people who are looking for, someone to trust to take care of their funds, or the hot fund manager or whatever, is that balance over brilliance is the way to evaluate people. Um,
Yeah, I don't know if you've seen it. I have to see if I can find it. Shaquille O'Neal was doing this interview once where he talked about how when he was a rookie or when he was very early on in his career and he was interviewing different financial advisors or things like that to help him manage his wealth. And he talks about how like there were so many that were like, "Oh, I'm going to make you 50% returns. We're going to put it in this. We're going to take over the world, blah, blah, blah." And then he said there was this little quiet, demure guy that was like, "Yeah, let's buy some bonds. Like, let's try to get, maybe 4 to 6%. And then once we grow that over time." Anyway, he said he went with him, that was his advice to people who at least, I mean, he's starting from a huge base, right? But I always enjoyed that story. We still have a lot to get through, so we're not going to be able to get to all of it. But speaking of correct calls and speaking of psychology, the CPI was released this week. It increased 0.4% in February on a seasonally adjusted basis after rising 0.3% in January. Over the last 12 months, the all items index is up 3.2% before seasonal adjustment. The index for shelter and gasoline rose, and those two increases in those indices accounted for over 60% of the monthly increase in the index for all items. Energy index was up 2.3% month over month. Before this month, for the last 4 months, energy prices had been declining month on month, so now rising 2.3%. Now that means they're still down year on year. So if you look 12 months ago, still down on energy 1.9%, but we're talking about dojis and reversals. At least in the CPI data, there's now a reversal for you. Instead of 4 months of decline, we now have an increase. Our buddy Chase over at Pinecone Macro put out a couple things that it was the 3-month annualized core CPI highest since May, 6-month annualized core CPI highest since July, 3-month annualized supercore highest since June, 6-month annualized services CPI highest since February 2023, running at almost 6%. The last thing I would just put in mind, if you look at the Brent crude chart, we've been talking about Brent crude hanging out, range bound, 75 to 80, maybe a little bit over 80. Starting to poke its head up into what looks like an uptrend, but where it looked range bound before, now maybe an uptrend looks like it's coming up. So as we're recording here on Thursday morning, futures contracts for Brent crude around $84. There was also, and we won't have time to get into all this, but there was a really interesting paper published in the National Bureau of Economic Research. I have not read all of it yet. I've just skimmed all of it, but it talks about how the United States transformation as a net exporter of natural gas has actually led to a significant increase in energy prices, comparable to a $30 per ton carbon tax, roughly $30 per ton on natural gas and 20 per ton on on coal, just because of how those markets work together. And that sort of roughly an LNG induced increase of approximately $1.60 per BTU, which, I mean, to put that in terms, that's double what natural gas is going for right now in the United States. So, a very, very clear signal that U.S. exports of natural gas, even though natural gas prices are at a ridiculously low level, sort of going back to the mid 1990s, those those exports are starting to appear in the price. And then last but not least, just we have a short-term energy outlook from EIA. On the one hand, I'm tempted to say if you need toilet paper, print it out. Their forecasts are not always super great. Um, on the other side, though, they're expecting gasoline prices to be lower over the course of the year, but expecting nominal gasoline increases May through July, and those exceeding prices for 2023, which is the period we're about to get into. They're also expecting Henry Hub spot price to remain below $2 um, in the second quarter as the season ends, but still talking about record lows adjusted for inflation and all of the things that were going behind that. And they see natural gas production still unchanged, despite some of the announcements from natural gas companies like Chesapeake talking about finally cutting production. So nothing super firm in there, but I don't know. We've been saying inflation and what if energy reverts to the mean, and I don't know. You get a bad print here, and you get some signs in energy. So how do you make sense of it, Rob? How does it look to you?
Well, we've been talking about this for quite a long time about the drivers that we think are going to push inflation to reaccelerate, and that appears to be playing out. Um, the only thing I would add here is this is partly, again, I think I say this a lot. This is why it's so important to pay attention and to be a bottom up investor when you're doing this kind of macro, because it doesn't take a rocket scientist to just listen to what the companies are saying. And all the companies that we work on, like in retail and consumer, the big things that are so obvious are, number one, they've all worked down their inventories, and now inventories are fine. So that sort of deflationary tailwind in the market has gone away because now they're rebuilding their inventories. And I'm a broken record on this, so I won't go into it again. But inventories flat to up now. That's a big deal. Number two, freight. 2023 was a huge crash in freight prices. That is bottoming out, and that's a big, big deal. And the reason is because you have to put yourself in the mind of a CFO or a CEO. Like, all of these companies raise prices into the end of 2022 and into the very beginning of 2023. That was sort of the peak of the inflationary surge. But they've been coasting on that. Like, everyone cares about year over year growth. Like, every company, when they want to present good numbers to Wall Street, they want to show year over year percentage growth rates. So they had raised those prices, and they have not anniversaried that yet. So all of their revenue growth, like if you look at any consumer company, pretty much in the last couple of quarters, revenue growth rates have been quite high, even though the volume of stuff people have bought in many cases has gone down. So they're getting this huge inflationary tailwind from those price rises, but now you're starting to lap that. So I think the rubber really hits the road here when businesses say, oh shit, like we have to put up some revenue growth here. We need profits to grow. We can no longer rely on falling freight and falling energy to cushion our margins. So they're going to start raising prices again. And when they do, people are going to freak out because they thought that this was done. So that, I think, is sort of the bottom up, cynical stock investors' take on this very macro issue. But so far, that's the inflation issue has been moving very much in our direction. And yet, I'm looking on the Bloomberg, the interest rate expectations a month ago were that interest rates, overnight rates, would go from 5.3% at the midpoint to 4.3% at January 2025. So there was pricing in 1 percentage point of cuts on average. That's the probability weighted, assumption between now and January. 1 month later, after a few prints here, it's only gone up from 4.3 to 4.4. So interest rate markets still don't believe what's going on. That's why I say, like, okay, that sounds really wonky and boring. Well, the takeaway is everyone who owns bonds should be really concerned about that. Because if we're right about inflation and bond markets finally start to wake up and price in, hey, oh shit, this is not the beginning of a cut cycle, it's the beginning of, a move back upward, that is going to move very quickly in the opposite direction. And anyone who's sitting there owning bonds is going to lose money.
Yeah, I mean, the political pressure is pushing the opposite direction. I mean, Biden is saying things on the campaign trail about how he thinks his buddy Jerome is going to cut. He's going to look at the data and he's going to cut. And the Biden campaign um, needs, I mean, they've put a lot on winning inflation. So I feel like at least some combination of political pressure and also that narrative being so ubiquitous is maybe what's keeping that narrative so sustainable. And maybe the politics will intervene in a way that we're not expecting. Although, I mean, if we're right about the underlying fundamentals here, if the Fed did cut rates, I mean, probably you'd see a massive surge and they'd have to fix it right then and there. So, but those are my best guesses there. I worry a little bit about how U.S. politics, I mean, I'm always worried about how U.S. politics is going to affect these sorts of things, but it's a pretty volatile time to have this kind of uncertainty when it comes to inflation and interest rate expectations as we get into the real pinnacle of the presidential election campaign.
Well, I don't think Jerome Powell wants to go into a potential Trump administration with rates any lower than they need to be,
Mm.
because that was the big battle that took place the last time. And Jerome Powell wants to do, I think, genuinely what he thinks is best for the economy and for the country, and his sense of civic duty and blah blah blah. The notion that he's going to cut because Joe Biden wants him to, I think, is pretty fanciful. And especially, I hate to say it, but if you look at some of the cuckoo craziness that's happening in markets around speculative activity, Nvidia, like, he is clearly paying attention to this. And if you remember 6 months ago, when markets were on the floor, he had come out and said, yeah, some of the risk premium is signaling in markets that markets have tightened, and that's good. So what do you think he's thinking now that the S&P 500 is, soaring to 5250, and Nvidia has just tripled, and it's AI mania, and everyone is, doing single day option trading on their phones? Like, do you think that Jay Powell is going to be cool with that? I don't think so.
Not to mention Bitcoin over 70,000, and people saying, "Oh, maybe I should go into Bitcoin mining." I mean, I'm starting to hear the crypto talk from people who had been in the fetal position as a result of the crypto winter recently. So
Did
yeah,
you see
no.
there was a guy on Twitter, I don't know if this was fake, but it was funny, even if it was fake, where he posted a text message exchange where he was texting his landscaper and said, "Hey, are you guys going to come cut the grass? I haven't seen you for a few weeks." And the guy said, "Oh, I don't cut grass anymore. I just made $1 million in Cardano."
Oh man. Well, apparently we missed that candlestick.
I hear
So
it's
maybe
very
we should
easy.
get off our butts on the podcast and go make some millions of dollars with Cardano for our clients. Just really, really quickly, our CI knowledge platform is our database for everything important that's happening in the world. And you and I and other folks on the team are constantly pouring stuff into there and giving initial takes and initial analysis on it. CI clients have access to it. We have a couple of research clients who don't use us for money management services and things like that, but want access to the research too. So we have clients who can just get access to the research. All of that preamble to say, we label things on importance 1, 2, or 3. And 3s are just sort of, hey, if you throughout the course of your week maybe get to this, you might want to pay attention. A 2 is you might want to stop what you're doing and just glance at this. If not right now, by the end of today, just make sure you take a look at this. And then 1s are stop what you're doing, This is really, really important. I don't care what meeting you're in. Like, this is how important we see it. Both you and I put ones this week. I'm very, very Spartan with my one ranking because when I give a one, I want it to mean something for a client. I know that you are also pretty Spartan with it too. So I thought before we close, even though we're at the hour mark, just both saying what put ones on the knowledge platform for us. And I'll start. It was a French magazine called Marianne, um, got its hands on a report from French military officials, talked to a bunch of French military officials, and not only concluded that a Ukrainian military victory seemed impossible in the war against Russia, but that the conflict had entered a new phase in December. It talked about how Zelensky needs roughly 35,000 men per month, and that he's recruiting roughly half of that. And there's a controversial draft bill to mobilize more Ukrainian soldiers that the Ukrainian government is actually debating sort of this week that lends some of that credence. But the real thing that was shocking to me was, quote, the risk of a Russian breakthrough is real, end quote. So my working model right now has been, well, Russia is also exhausted. They've sort of, pushed back on some territory. They're probably going to make this a frozen conflict, lick their wounds, and then maybe 12 months, 18 months, 24 months from now, they will try again. I didn't think they were giving up, but I thought we were going to enter maybe a pause from Russia's point of view. And this article says maybe not. When you start looking at what they've done, that they've changed their MO by compartmentalizing the city and by using particular types of bombs on a large scale for the first time, the way that they're using artillery, the way that they are getting air and ground assets to actually cooperate together and move forward. They described it as hell for Ukrainian defenses. Um, Also showed that Ukraine's armed forces have tactically shown that they don't possess the human and material capabilities to hold a sector when it is when it is subjected to this type of effort. And what the report concludes, what the Russians are going to do with this remains to be seen. It could be that they're just nibbling at the edge. But it also suggests that they could try to break through in depth, and that if you are a Russian military leader, you could see this and say, maybe I could break through in depth, and that these recent maneuvers allow you to think that. And that I feel like I'm parroting George here a little bit from my GPF days, but he used to talk about maskirovka, which is this idea of Russia disguising its true intentions, and that what Russia might be doing here is showing weakness as it pushes much further strength while the Zelensky government is under such pressure, while the West hasn't really showed up for Ukraine in general. I am not telling you here that I think that Ukraine's defenses are going to collapse, but I will tell you that earlier this week I told a client that my baseline scenario, and I'm starting from scratch. I don't feel comfortable about that baseline scenario at all. And the reason I gave that a one on our knowledge platform was to signal to clients like, I'm very, very nervous and uncertain about what's going on here. We're going to have Sim back on the podcast. I also, to cut in the opposite direction, a Ukrainian author who wrote a book about the initial stages of the war. I've been reading it, and he'll be on the podcast in a couple of weeks. It was instructive to read that book while I'm in the water park capital of the world, because the French and everybody else have been saying this for years, that the Ukrainians didn't have a chance and didn't have the materiel and didn't have the soldiers. And the Ukrainians have proved over and over and over again they're not giving up, and that they can lose battles, but that they are in it for the long haul, and that they're not going to just surrender to the Russians, even if there is all these political, even though there is all of this political volatility and negative signs on the battlefield. So maybe I end back up with my base case scenario, but a one on the knowledge platform for me this week, because I feel very, very uncertain in making that case until I do some more work. Tell us about your number one.
Ooh, well, geez, I really I want to talk more about Ukraine. Um,
Well, I don't have anything to talk about. All I have is my previous model. I feel like it's broken, and I have a lot of work to do in the next week or two to talk to experts and look at things that are going on the ground and see if I can rebuild back to the old model, or whether I'm going to say something else. So, I mean, we can shoot the shit if you want about Russia, Ukraine, but my key takeaway for you is just that I'm feeling very, very lost in terms of where my sort of analytical North Star is for that conflict in 2024, and we'll try to get it back as soon as I can.
the only thing I would add on the Ukraine before talking about my number one, which is completely unrelated, is I found this pretty striking. We went this weekend. When we were in Brittany, we went to visit some friends of my wife's family, and the guy and his wife who we went to visit, they live in Brest, and they're diehard political activists, and they're in the France Insoumise party, Mélenchon's party, the far left.
Mm.
And we had some wine and whatever, the usual apero stuff. And the guy who cannot resist talking about politics like nonstop and just parroting the line, he had just come back from a protest for women's equality in pay, by the way, which is why we were a little late getting the apero started. Um, I asked him, I said, well, what do you think about Ukraine and what Macron said in terms of providing additional support and maybe troops and stuff? And he said, the war is already lost. Ukraine has already lost. That's obvious. And the best thing for France to do is to make peace with Russia and accept that, which I thought was really striking, and I think sort of indicative of a large portion of that segment of continental European thought on the subject, um, which is sad and from my perspective and surprising. But as we reformulate your baseline, I think trying to understand how this might galvanize or not Europe into changing its policies is one of the big things from an investment standpoint.
Well, and I don't think it's a coincidence that Macron is out there either recirculating or publishing videos of the early parts of the conflict. I mean, I shared this on our Slack chat or whatever. I mean, the videos of Macron talking to Zelensky in the 24, 48 hours after the election. First of all, humanizes Macron in a major way. I mean, obviously he released it or allowed it to be released because it makes him look good. I know that, but boy, he does look good, and he looks like he's dealing with gravitas, and that he is genuinely shocked that Putin did it. So I think he would, if he was having a apero with your with your friend. I can imagine what Emmanuel would say to him. But anyway, why don't you take us to China to close us out?
Yeah, so I mean, this is a much bigger conversation, which I'll try to keep short in the concerns of time. But my number one was there was a piece in the Financial Times which was talking about how in China, local officials in two of the most indebted and economically troubled northeastern provinces in Liaoning and Hebei had basically gone to the central government and were negotiating how to get bailed out, how to secure financing, how to restructure their debt, which I thought was interesting in itself. But one thing caught my eye, which was not only that they were sort of bending the knee, so to speak, to the central government, but also that if you read what the finance minister of China said in public, he said that they're pushing for a broader restructuring that includes asset sales. And I thought that was really interesting because everyone thinks about this in terms of restructuring your liabilities, but part of restructuring your balance sheet is always, well, you have to restructure the asset side too. And this seems like, why would this be a number one? Why should we care? Like, big deal. One of the things that we've been flagging for so long here is, okay, what are the signposts that you get meaningful change, meaningful restructuring of the Chinese economy that could cause some major shifts? And one of those signposts that we had laid out was the perspective for wealth transfers from local governments to households or the household sector, and basically the removing or the disentangling of the tentacles of local governments from households' throats, so to speak. And the mention of asset sales really caused me to sit up and pay attention, because that is the beginning, I think, of what you might see if there was sort of broader um, restructuring of the kind that we would want to observe. And that's a really big, it's a really big deal. And I don't want to go into history and everything because we don't, whatever, we've been going for a long time here. But when you think about this, like, this goes back to a long time. And so much of Chinese history, so much of the Communist Party of China's history has been about land reform. And if you think like Japan and China both faced similar challenges after World War II in terms of land reform, and Japan, under our boy General MacArthur, completed the most, you know, uh, I don't want to use the word severe, but very, very aggressive and very democratic land reforms where they seized assets from the people who had them and distributed them with very low compensation, by the way. This was a confiscation underseen by MacArthur, and he architected it, as you know, to individual Japanese households, and everyone was given their small plot, and it was a huge success. And as everyone knows, China did not do that. They went with collectivization, and it was what it was, as we all know. Um, the book that I think is really good on this is Yasheng Wang's Capitalism with Chinese Characteristics, which is sort of wonky and academic, but it's worth reading because it talks about in the 1980s how China tried to undo that by unleashing more bottom-up reforms, by enabling people to own businesses and start businesses through these township and village enterprises, and that this was really sort of a grassroots sort of attempt to shift ownership and economic power in a more broad direction. And then, of course, after Tiananmen, that was squashed, and you saw the beginnings of what we've been experiencing for the last 30 years. So I don't want to make a mountain out of a molehill, but if you look at China today, this was surprising. I actually looked up the Gini coefficient, which is the measure of inequality. China's measure of inequality is equal to the United States. Like everyone talks about, how the United States is so unequal. I mean, China is facing the same issue. And it brings us back to 1945. It brings us back to the same issue that has been the driving force of, the communist wave and everything for the last 75 years. Is this the beginning of trying to rectify that, to take a new approach? And again, don't want to make a mountain out of a molehill, but if you start seeing more talk of redistribution of wealth, redistribution of assets to individual households, I would say that is of an importance equivalent to, the start of collectivization in the 1950s. I mean, that is a big, big deal. So that's why it's one.
And I'm sure we'll pick it up there, if not next week, in the future. All right, I'm not going to go enjoy the water park, but I got to go give a speech. So I will see you later, my friend. Thank you so much for listening to the Cognitive Dissidents podcast, brought to you by Cognitive Investments. If you are interested in learning more about cognitive investments, you can check us out online at cognitive.investments. That's cognitive.investments. You can also write to me directly if you want at jacob@cognitive.investments. Cheers, and we'll see you out there. The views expressed in this commentary are subject to change based on market and other conditions. This podcast may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. Cognitive Investments LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Cognitive and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.cognitive.investments. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor.